Why are prices crashing before facts arrive? When fear trends faster than news, markets stampede. Look closer. The panic is social, not just financial. Red arrows dominate every screen. On trading floors, controlled chaos turns to raw emotion. Everyone is panic selling. But to understand what's truly happening, you can't just read a chart. This isn't just economics, it's a social phenomenon unfolding in real time. When a critical choke point like the Strait of Hormuz is threatened, it's not just barrels at risk, it's the stories we believe about safety, scarcity, and the future. Those narratives spread like a virus through our interconnected system, and prices react violently. This is the sociology of a market panic. At the heart of any market shock is a concept sociologist Stanley Cohen termed moral panic. It's a wave of intense, shared fear about a perceived threat, which is often exaggerated and distorted by media and political figures. This fear spreads far faster than verified facts can catch up. News outlets, competing for attention in a saturated market, frame events in the most dramatic terms possible. An incident becomes a crisis. A dispute becomes a standoff. This creates an amplification spiral. Media reports fuel public anxiety, which in turn generates more clicks, shares, and viewership, prompting even more intense coverage. The initial event, whatever its objective reality, becomes buried under layers of collective emotion and social construction, setting the stage for what happens next. To grasp the scale of the panic, you have to understand the geography. The Strait of Hormuz is the world's most important oil choke point. According to estimates from the U.S. Energy Information Administration, nearly a fifth of the entire planet's daily oil consumption passes through this narrow channel. Major exporters in the Persian Gulf rely on it to reach global markets, and major importers in Asia, Europe, and North America depend on that flow for everything from transportation to manufacturing. While some alternative pipelines exist, their capacity is a fraction of what moves by sea. They cannot compensate for a major disruption. Any blockage here, real or perceived, sends an immediate shockwave through the global energy system. The price transmission is almost instantaneous because the market isn't just pricing in a current shortage, it's pricing in the of a catastrophic, prolonged one. Faced with this profound uncertainty, humans look to each other for cues. This is classic herd behavior. When a few influential actors make a move, like a major hedge fund selling off energy stocks or a sovereign wealth fund buying gold, others follow, assuming the first movers have better information. This isn't necessarily irrational. In a data-scarce, high-stakes environment, it's a cognitive shortcut. But it can lead to devastating information cascades, a concept explored by economists Abhijit Banerjee and Sushil Bikhchandani. In a cascade, people start ignoring their own private information and analysis, however limited, and simply copy the actions of those ahead of them. The logic becomes circular and self-reinforcing. The result? A stampede, where everyone sells simply because everyone else is selling, regardless of the underlying asset's true value. In this environment, every trade becomes a social signal. Hitting the sell button isn't just a financial decision, it's a public declaration of prudence. It signals to your peers, your clients, or your online followers, I am being responsible. I am protecting capital. I am not the reckless one who holds on too long. This is especially true for professional fund managers, who are judged not just on absolute returns, but on their performance relative to their peers. This is called career risk. Falling with the market is acceptable, even expected. You can explain that away as a systemic event. But falling alone, by holding on when everyone else sold, is a fireable offense. The incentive is to conform, to join the herd because safety is found in numbers, not in being right in isolation. However, not all actors behave the same way. The market is composed of different social structures with different rules. Retail investors often act in tribes, congregating in Discord servers, group chats, and on influencer threads. Their actions are shaped by shared identity, the tech believers, the gold bugs, the option cowboys, and fueled by memes, momentum, and a sense of community. Their decision latency is near zero. Institutions, by contrast, operate within rigid organizational frameworks. They have risk committees, pre-approved playbooks for black swan events, and defined roles. Their decisions are slower, more bureaucratic, and governed by norms of compliance and fiduciary duty. They act as organizations, not as a crowd of individuals. This creates a fascinating dynamic where the fast emotional reactions of the retail tribes can force the hand of the slower, more deliberative institutions. Modern panics are supercharged by technology. Social media and news algorithms are not neutral observers, they are active participants. These systems are designed to maximize engagement, and nothing engages like fear, outrage, and anxiety. The loudest, most emotional takes get amplified, while nuanced, cautious analysis is buried. The algorithm rewards the panic. This creates a pernicious feedback loop where the market's volatility is mirrored and magnified in the digital sphere, which in turn feeds back into market decisions. Traders, both retail and institutional, are watching these trending topics, creating a world where a viral tweet can have as much impact on short-term price action as a report from the Federal Reserve. The specific words used to describe the crisis are critical. Language frames our reality and guides our behavior. Is the event a temporary disruption or a strategic blockade? Is your portfolio a war chest for opportunities or a safe haven for protection? Each frame suggests a different course of action and a different emotional response. When headlines are filled with military and crisis metaphors, investors are primed to think in terms of defense and survival, not growth and opportunity. This framing isn't accidental. It's deployed by media, politicians, and market commentators to shape perception and drive behavior that aligns with their interests. This leads to the classic flight to safety. But this isn't just a cold calculation of financial yield. It's a social ritual. Moving capital into assets like gold, the US dollar, or short-term government bonds is a performance of caution. These assets are culturally coded as safe. They become badges of prudence displayed to peers and stakeholders. The demand for them is driven as much by their symbolic meaning as by their financial properties. Simultaneously, we see sector rotation. Money flows out of assets perceived as vulnerable, like high-growth tech or consumer discretionary stocks, and into industries that represent security and stability in a time of conflict. Defense and energy stocks rally as society reassigns legitimacy and capital to them, not just based on future earnings, but on their role in the unfolding geopolitical narrative. Ultimately, the price of oil, stocks, and bonds doesn't just reflect supply and demand. It reflects the dominant story the market is telling itself. A spike in oil isn't just about the number of barrels that might be taken offline. It's about the narrative of future scarcity, of escalating conflict, of a world becoming more dangerous and unpredictable. Markets are mirrors of our collective anxieties, hopes, and stories. When you zoom out, you see that price charts are not just data. They are a map of culture under stress. They are a real-time sociological survey of our shared beliefs. So if you truly want an edge in understanding these events, don't just study the economic graphs. Study the groups. Analyze the network maps of information flow on FinTwit. Read the institutional research notes, not just for their financial models, but for the language and framing they use. Track the chatter in retail trading communities to gauge the emotional temperature of the market. The professionals don't trade the headlines. They trade the reaction to the headlines. They watch for key levels, like oil hitting $100, and monitor flows into safe havens like gold and the dollar. Because when crowds move, it is the invisible forces of sociology that are moving the market. Quick question. In a panic, do you follow the herd or map the network behind it? If you want more Sociology Meets Markets breakdowns, hit subscribe to Smartobrains. Stay ahead of the narrative. Quick question before you go. What's the single strongest social force driving market panics? Media framing, herd behavior, or institutional playbooks? Comment your take below. If this helped, subscribe to Smartobrains for weekly data-driven breakdowns and turn on notifications.